Our panel, now assembled in front of you, concerns itself with the state of art in factor models from theory to implementation. Our distinguished panelists, all well known in the field, are well qualified to give this subject the comprehensive beatdown it deserves. From the Vanguard group, immediately to my left, please welcome John Ameriks, who leads the Quantitative Equity Group. QEG manages more than $30 billion across 34 mandates. As well as portfolio management, John is also a high-profile industry expert representing Vanguard in public discussions of investments, portfolio construction, retirement advice, and retirement income management. He graduated from Stanford as an undergrad and has a PhD in economics from Columbia. Thanks very much for joining us today, John.
Thank you.
Now, immediately to John's left is Giorgio de Santis, founding partner and director of research at Kepos Capital, familiar to many of us as a leading quant hedge fund manager. Giorgio was a managing director at Goldman Sachs and came over with Mark Carhart and Bob Litterman, who has in the past kindly served on our board along with now Giorgio, to have established Kepos in 2010. Since then, the firm's principals have cemented a reputation for quantitative scholarship in the same manner that a number of firms in the room have. That is, they publish in the leading professional journals. Giorgio and his co-authors, for example, won the Graham and Dodd Award of the CFA Institute for their article Exotic Beta Revisited in the Financial Analyst Journal in 2014. Giorgio took his PhD from Chicago, where we overlapped, I think, for at least a minute. And he's also been a teacher at the Marshall School at USC. Giorgio, welcome.
Thank you.
Immediately to Giorgio's left is Wai Lee, who is head of quantitative investments and senior portfolio manager at Neuberger Berman. Dr. Lee certainly qualifies as a senior statesman of quantitative asset management, having worked at Neuberger for 13 years now, and before that as senior quant jobs at Credit Suisse and JP Morgan. He's also a prolific author of award-winning articles in the major professional journals and author of the book Theory and Modeling of Tactical Asset Allocation. He has an engineering degree from University of Hong Kong, MBA and PhD degrees from Drexel University, and did postdoctoral work at Harvard on the stability of the global financial system. Wai, thanks so much for joining us.
Thank you.
I'd like to start off by asking for the panel's view of the recent history and maybe long-term history of factor models. Where do they come from your perspective? How are they useful in your practice? And ultimately, we'll get to where they're going. I'm going to start with John.
When we talk about factor models and factor investing, the Quantitative Equity Group at Vanguard is a team that's been around for 25 years. I don't think we ever really talked much historically about what we do as being factor-based. It came up more out of looking at firm characteristics and the sort of accounting information. We try to talk about what we do in the quant shop as being fundamentally oriented. It's a quantitative process, but we're doing fundamental evaluations of firms. Over time, certainly things have evolved. While we're doing our little thing at Vanguard, the industry's evolving, the academic literature is evolving. For us, the landmark, I think, in all of this is no sooner is the CAPM out there and then people are trying to test it when they're finding that, look, things don't quite operate in accord with the capital asset pricing model. There are some anomalies out there that appear to be persistent. That gets the label of the first factor, and I think things go from there. For us, all of this factor-oriented structure, I think we'll talk a little bit more about this, we've taken a strong view that this is an active approach. Somebody mentioned earlier this morning that there are many index funds out there that pursue these factor-based ideas. While there are indexed implementations, we think in order to use this type of a structure properly, you really have to approach it from an active point of view. Maybe we'll talk more about that.
Okay, good. Giorgio.
Okay. Clearly, 20 minutes is a binding constraint here. But, the way I see it for our industry is what we call now factor models, to be really honest, is what I think a lot of people called alpha when I started in this business. So, in the late 90s, if you were a quant and you went in front of an investor, the challenge was to even get to sit with the investor because they go, oh, you guys have a black box. But then the effort was mostly trying to reassure people that, well, what we're doing is really not that different from trying to find value opportunities or carry trades or things that even your discretionary managers do. But what we do is more systematic. We try to remove emotions from what we do, and we get to look at many more data and so on. Now, with time, of course, and with competition, with pressure, the search for alpha has been pushed to the limits. And the idea of investing in ideas like carry and value and momentum and so on, you can't really argue that you're the only one doing it, or you're the only one that has that special idea, that special opportunity. So the way we see it, we say, well, it is something that definitely belongs in your portfolio. In the long term, is going to be a good diversifier and a good contributor to your long-term strategic portfolio. But you can't really get away with saying, and this is something special that I do. The idea of factors is something that we believe now is and should be super transparent. You have to be willing to explain why you think those are risk transfer opportunities. And then maybe your contribution is actually to say, well, but let me tell you how you combine them. Let me tell you how you manage risk, what the distribution of expected returns looks like, whether there are tail events that you should be aware of, and so on. So that's really the way I see factor investing nowadays. Of course, you can't charge 220 for factor investing. So that has been definitely a big change compared to the old days.
So 2 and 20 is gone.
For factor investing, now if you can claim that you can also find alpha, then for instance, what we do at Kepos, we have actually defined this spectrum where we say we think there is a passive long-term exposure to global equity markets. That's traditional beta. You shouldn't pay anything for that. The other extreme is alpha, where hopefully we can find the little secrets that other people don't know how to find or are not as good at doing, and that's your alpha return. And in between is this, and obviously it's a bit of a gray area. I can't say that this is where we draw the line and say, this is not alpha, this is exotic beta. But in between are these returns from well understood sources or opportunities for risk transfer, and that's where the factors are.
All right, thanks. Why? Do you agree that the evolution is which we're really in some sense talking about, a factor investing, is just the distinction between known beta and unknown alpha?
Well, to a large extent, yes. And as a matter of fact, I was very glad to have these 2 minutes. Similar to John, in our workplace, we don't really talk about the history of factor investing. I may be the only one who has interest about it, but I observe that maybe nobody wants to listen. We all care about practice, right? Let's practice. Let's do it well for our clients. But I think before I get to your question, a lot of I think points very well made already. And I personally think factor investing is the right way to start investing. It may not be where you want to stop, but it is the right way to start. And I take it as it almost went back to the Arrow de Bruce times that they conceptualized states, which is very important for us to understand what is risk, right? Covariance in risk, how to do the risk transfer and the like. And I think to me some important evolutions dated back to 50s, 60s when we got these separation theorem, that what is investing, we need to figure out what is that one portfolio of risky assets, what is that one premium we want, right? How do you determine that? And allocation between cash. Then we got the answer in 60s, CAPM, the global, that should be the market premium. But to me, I saw that's where we started to see interesting things to happen. Empirical tests of CAPM found discrepancies, right? It did not fully explain the cross-sectional dispersions, low beta and the like. Then we saw PE tests, size tests, and the like. So empirical is one development. Then we got APT, the theory, right? Formed a solid foundation of how do we understand multi-factor world. I think the third development I saw was the need in the industry. How can you compute a covariance matrix for 3,000 by 3,000 when you manage equity portfolio, right? In the 70s, we saw that need, and we have to impose factor structure just in order to manage risk of these large portfolios. To me, I think the 70s, 80s planted the seed for more like a big bang of empirical asset pricing model. In the 80s, we got pioneers in the industry practicing the anomaly space, like this entangling the complexity. The 90s, in the last 10 years, we saw some asset management firms built by professors, right, practicing these factors, and we were trying to be a bit of it, practicing factor investing and the like. So definitely, I think the evolution is very deeply rooted in academic theory. And I do agree a lot that Giorgio said, these beta alpha, maybe we have more discussions around it, like when we accepted, such as in the discussion, we saw the slide about asset-specific pricing kernels, right? So then how do you define alpha and beta? If I find some sector-specific within equity signal that works, I think they will reject my paper that is not mean variance spanning or something like that, right? So we'll get there when we, maybe talk about alpha versus beta. I think that's an interesting discussion.
Okay, all right. Where have factor models, from your perspective, been most successful, and where do you think the challenges lie today? From a practical perspective, from a use perspective.
We talked a little bit about value and momentum and the combination of those two components being a part of a lot of the active quantitative strategies that are out there across asset classes. And I think to some degree, to the extent that people have been able to pursue that, they've been able to add alpha for their clients over time in an effective way, provided they didn't charge too much, right? That's always the trick. So in that sense, I think at the highest level, that's where the ideas have been successful. I think where we're struggling at this point is when do you stop? I mean, we spend a lot of time on value and momentum. Nobody's talking about size anymore. Profitability didn't come up. Quality, how many of these things are out there? And which are the important ones and the salient ones for investors to pursue, and maybe even more importantly, why? I think it's great to have a discussion in the room of the technical aspects of second moments and first moments, but you can't be from Vanguard and not think about how far away we are from where an individual client who doesn't have the history that many of the people in the room do, how far away they are from understanding any of this. And again, and just observing
Are
this
they getting
morning,
better? I mean, you open up the Wall Street Journal, you go to the business or the finance section, you see smart beta advertisements.
Oh yeah, no, and you go to, I came back from the Morningstar conference, the ETF conference, it was all factors all the time. So definitely there's a lot of people talking about it, but take 10 minutes and walk away from the panels and talk to the actual advisors that are out there dealing with clients, or listen to people on the telephones. They don't quite get it. They're not quite sure what this is. I mean, I think what makes this very interesting is that factor models and the way that quants talk has a structure to it. I mean, we should be more disciplined about it a little bit. We've gotten a lot of shorthand that we use. We talked about value this morning. Are we talking about book to market? Are we talking about cash flow to price? We know that those things make a difference, that value has a book to price connotation in a lot of the academic literature. And as practitioners, a lot of us are not focused on that idea. And we know that stuff matters. The rest of the world doesn't know that yet. So the terminology, the sort of lingo is evolved. And I think we're in a better place now. The question is, when are we going to get to this next stage of literally being able to tell people, no, this is what we're doing. Can we establish expectations around what someone should expect from a factor fund? And then for me, can we deliver on that in a way that's not going to surprise the investor? I think we can do it, and that's what makes it intriguing.
Is that a signal about where you think the industry is going, which we'll get to again in a moment, not to divert the main question, but a factor-based fund, is that really where we're headed? We're producing multi-asset class, multi-risk class funds ultimately? I mean, or is it starting from more of a micro perspective?
Yeah. And again, we're there in terms of the funds are there, the products are out there. I think the understanding is not there.
Okay, Giorgio? Is this something that my mother-in-law will be able to understand someday?
Hopefully at some points, but I would say I agree with
Have you met my mother-in-law?
No. I agree with what John said. That it's kind of ironic that one of the challenges is definitely trying to get investors comfortable with the idea of factor investing. And part, I guess, it's our responsibility. But this industry is kind of funny that way. As I said 5 minutes ago, people were willing to pay $2 and $20 for all of these things. And back then, there was not as much transparency as there is now. Now you offer more transparency, and the reaction is, well, I'm not sure really where to put this. And you go like, you can get it for 100 basis points fixed now. And so that's one thing. I think that one of the challenges has been there is a lot of interest, as John said. You go to conferences and people talk about smart beta, exotic beta, factor investing, but I do see still a lot of resistance to say, okay, we're ready and we're ready in size. Because if you think about it, compared to investing in alpha, if you really believe that this is a long-term strategic allocation to opportunities for risk transfer, then it should be a considerable part of your portfolio, as long as you understand the risks and so on. To me, having said that, the challenge that I see as a quant researcher is what are the real risk transfer opportunities and which ones are overfitted stories. I have come to become obsessed with overfitting. I'm really glad actually as an ex-academic that you guys are doing a lot of work on trying to show whether the evidence that's been found and discussed is really there, or if you tested 100 variations of something and finally something worked and then you wrote a little good story. I was telling somebody yesterday night, one thing that really frustrates me, and for full disclosure, I'm an economist, that's what my PhD was, so I love economics, but in the industry, when investors raise the question about overfitting, the one simple way to make them comfortable to say, don't worry, we use economic intuition. And to me, that is such a dangerous way of addressing the issue of overfitting, because you can overfit your model and build a cute little story after the fact, and you have to ask your investors, is it really economic intuition that gives you a guarantee against overfitting, or are you just investing with the best storyteller? And to me, that's a big challenge.
So overfitting, storytelling, but you have to have a story. We just heard a lot of commentary about getting the story right.
I know,
and then
but,
from an academic perspective, how do we deal with the fact that models are fitting the moments?
Well,
are chosen, are calibrated to fit the moments.
We do, but as I could give you an example if we had 3 hours instead of 20 minutes. But we all agree that you can use rates, presumably to predict currencies, say why intuition, inflation expectations, growth, and so on. But I can get together with 3 of you. You give us 20 minutes, and we'll come up with 30 different ways of using rates to predict currencies over a 30-year history, which is one draw from a very complex distribution.
Okay.
And then what? I'm going to pick the change in the slope of the term structure, and then I'm going to build a nice story around it, and I'm going to tell you why obviously it should be the change in slope of the term structure. What I'm not telling you is that I also tried the 3-month forward, the difference between this 12 and the 3-month forward, and so on.
Sure. Okay, all right. And in practice, of course, we have the Clover rule and other issues about backtesting. In academics, it's called the T-stat that gets the paper published. So how do you deal with that?
Well, first of all, I think personally, I see factor investing has been successful in both the first and second moments. Going forward, it's debatable, but the first moment, numbers are the numbers. Where we can debate whether these will persist or not, whether these are overfitting or not. So I do believe many of these factors identified, or we are practicing them, are a real risk for the risk transfer argument. The second moments to me is about we don't challenge. If I look at stocks, right, when I look at these common stocks together, I don't challenge it's a factor. We have accepted stocks as a factor. And I think that helps. As more of us practice these factor investings, yes, economic rationale is one thing, but if enough of us accept this idea of these are similar characteristics and I trade them as is, we will create that factor structure, at least empirically for some time, right? So that helps to me in the second moment sense is factor modeling will help in terms of modeling and managing the risk. So to me, both of them at high level has been successful. The challenge, I agree with a lot of what Giorgio said, that the overfitting is one. I am equally concerned about overfitting as well. As we dissect the universe into smaller subsets, there are always chances you see some even higher efficacy I am lucky enough to be in a fundamental shop. I haven't worked in a pure quant shop yet. Usually with that challenge, I usually will go to the fundamental guys and say, do you think it makes sense? And granted, sometimes after they saw the numbers, they can come up with a story. That's true, okay? Right. But at least I have that luxury of going to see a fundamental manager and I say, what do you think? Another challenge that I have personally experienced is also like overlap with the other panelists is how do you help your clients to accept this? Like I have been in meetings with their board members to explain to them what is factor investing. So I think that quote and unquote educational element will still persist at least in the near future.
In what asset classes do you find the greatest horizon for the application of the notion that covariances or co-skewness or kurtosis and all the conditioning definitions or versions of it all, where is the horizon? Where's the blue ocean in practice versus
well, look,
the red
I mean,
ocean?
maybe it's a little boring, but we look at the mission around here is to take cost out of the equation for people that are investing. That's what we do. There's still an enormous amount of the world that hasn't picked up on these ideas, that is still paying too much for mediocre active management that is amounting to some type of factor exposure within the equity space. I think there's still an enormous amount of work to do to try to talk to people about that and to influence the world there. I think there are a lot of institutional organizations in general, $100 billion plus clients that are more on the cutting edge and maybe up to speed with more of the folks in the room, but there's still an enormous amount of runway or horizon or blue ocean out in the broader world. And it's an area where I think there's still an enormous amount of cost that can be taken out of the system to provide people with, I think, structures that would be at least as good as what they currently have in place. We can all argue about, well, what can the industry do? What can the people in this room do to make those solutions even better? But certainly, there's still more room to run in terms of.
Sounds like a signal.
It's that's the why would a $4 trillion index shop get interested in factors? Everybody asks that. It's not about indexing versus active at Vanguard. It is about taking cost out, and index funds are great ways to lower cost. But you can do that on the active side as well. And this type of structure and the transparency that it involves gets you pretty close to being as upfront and as transparent and as process-driven as we can be on the index side, but add value in some way for an active investor. Either pursue outperformance because we believe there's a risk transfer, or influence some dimension of risk in a portfolio.
There is an interesting thing in the industry that we're really good at making things complicated, right? So factor investing, as my colleagues have said here, has been fairly popular in equities, single equities, right? And for some reason, somebody decided that, okay, we're going to call those smart betas. So you go to conferences and everybody talks about smart beta. Now, we happen to focus on what is called macro investing. So instead of investing on single names, we focus on trading futures, forwards. So typically the asset classes where we do a lot of research are equity indices across the globe, global rates, commodities, and currencies. And so there are great opportunities for factor investing there. But those, for some reason, are called exotic beta, not smart beta. And I would say there are opportunities there as well. And it's relatively easy to explain to investors why those are good
institutional
opportunities for yes, absolutely.
Consultants, institutional.
Yes. The one thing that probably is not a surprise to you, however, is that performance kind of matters in the industry, right? So what happened if you look at returns over the past several years, I would say through the end of 2015, what people call smart beta, so factor investing in equity single names, did really, really well. We could spend a lot of time discussing whether it was really pure factor investing or there was a little bit of hidden beta in there. Let's leave that aside for now, but it did really well. Macro, on the other side, was kind of flattish for about 3 years or so. And so as much as people say, I would love to have this in my portfolio, but I can't really go to my board and make the case for this. Well, sure enough, early last year, a lot of funds that offer smart beta, so single name equity factor investing, got really crushed. And last year and early this year had been really great for macro investing. So now you get a lot of conversations, and a lot of people want to look into macro factors or exotic betas in these other asset classes. So my feeling is that it's ironically, it's a new field for a new area, and so it will take a while. People will have to see good and bad times. As one of my colleagues suggested, I think seeing good and bad times will help people understand why you have those things in your portfolio. Like, when the market crashes, maybe you do have other factors that help you hedge the pain, but it'll take that.
Okay, all right. Why do you have anything to add?
Yeah, just quickly, one point to add is I believe that the big clients, the big portfolio should better be more thinking more about factor investing, because the way I understand is big clients tend to have multiple managers, and diversification, you like it or not, is far more effective in diversifying away your alpha, the idiosyncratics, than the factors. So if you are running a huge portfolio, I'm almost thinking like you have no choice but to think about the factors. What are your factor exposures? When you aggregate all your managers up, I think that's where maybe one path to the ocean.
So you have to.
And just one other thing, I mean, we mentioned too, the amount of money that is now, the different ways of calculating how much money, even in the equity space, again, I'm going back to my hobby horse here, that there's still room to run in equities, because if you look at what's being called factor strategies, it's minimum volatility, it's dividend-focused funds. It's a few products that have gotten a lot of attention because of a spate of really good performance. The notion that there are a lot of providers out there offering a robust suite of factor-oriented, either multi-factor or individual factor funds, and that there are lots of individuals out there that are implementing strategies that are based around that, that is what is not happening. It tends to still be now that, there's a lot of attention in the space, a lot of discussion, but it is very traditional sort of index orientations around dividends, min-vol, and traditional things like value that have gotten the assets. Whether that really amounts to a robust analysis of factor exposure and how to leverage that in a portfolio, it's just not there yet.
It's at the edges, but it's coming, here's what you're saying. Yeah, so other carry trades being democratized.
Yeah, it's,
if you like, other notions of covariance being democratized.
It's always a little less exciting for folks that have talked about this. I mean, we've been talking about this for 35, 40 years in academia, right? And it is just now really starting to catch on, and I still don't think the hard work of trying to explain this in a way that makes it more useful to the end user, that's a step that maybe it's a little less boring. It's the teaching part of the job for a research professor.
Right.
That's the part that needs to get done.
Okay, all right, thanks folks. We'd like to open up now for your questions and comments.
I'd like to heckle John a little bit about the clients of Vanguard. It seems to me that Vanguard offers a platform that's perfect for factor investing, because you can choose among a whole bunch of different equity funds, fixed income, tips, international, and you say you ask a client, they don't know what they're doing, but there's a wisdom of crowds. In aggregate, all your clients are actually spanning the full space of factors that are available by investing in your funds. So I think when you look at, and then you allow them to switch freely between one and another. So it's perfect. You don't need anybody else except Vanguard, in my estimation, to do factor investing.
And Vanguard, to my knowledge, does not pay commissions. So, thanks, Dan.
Thank you for that. And I suppose that my job to say, look, where we would start with an investor is an index fund. And that goes back to what I said at the beginning, is we view all of this as active. I will, I'll also say though that, Vanguard started as an active shop with Wellington and that relationship. And we have always utilized external managers. We put a lot of pressure on price. That's what we've always done that. And so, I think there is a need for other managers out there. It's never going to be all Vanguard. And particularly when we talk about factors, I don't think we've figured this all out. We have what we think are robust, reasonable implementations of a lot of these things. And I think in conjunction with an advice service, you're right, we think we have a pretty good model. But
you haven't figured it out, but your clients have. They're doing the factor investing by allocating funds across your...
By definition, right? By definition, if you invest in an asset, you take on factor risks.
Can I challenge a little bit so that, because I have to take somebody, I can take somebody from Vanguard, they have a time there, right? I would say my experience, I can see your argument about the wisdom of crowds, but remember that a lot of times when you talk to institutions or you try to explain to them what they should do for their portfolio, the level of knowledge can be relatively limited, right? And so the argument that, well, the opportunities to invest in factors are there, I agree, and Vanguard definitely has a very large set of opportunities, but there is a risk management component that is extremely important, right? So I'll tell you, you talk to people and say, well, I like the idea of selling volatility, for instance, as an opportunity to collect premium. However, there are convexity issues, there are extreme events, concerns, and how do I diversify that across asset classes? What do I do when something happens? And let's be honest, people, if you said you can switch quickly at Vanguard, it is absolutely true, and for free. The question is, do you want to switch quickly and for free? Does the average person, the average investor, know how and when to do it? Do they have enough information to do that? I would say you guys as academics have shown plenty of evidence that people tend to trade too much at the wrong time, and so on and so forth. To me, that's a little bit of there is a timing component, there is a risk management component in there. The biggest challenge, to be honest with you, in managing money and putting these things together is really not the simple mean variance optimization platform, is the other moments. And I'm not going to argue that we have the magic solution to that, but we definitely focus on a lot of those things, despite what Nassim Taleb may say.
What do you think, what is the systemic risk that'll manifest in the capital markets when factor rotation accelerates and recent consumers of factor portfolios begin to understand what they don't know?
Okay.
Believe it or not, there are a lot of people out there, a lot of institutions that still start from the idea of, okay, I have a 60-40, 70-30 allocation to equity and bonds, right? And that's
Or 80-20 these days.
Yeah. Yeah. Well, in terms of risk decomposition, 90-10 probably, right? But that kind of goes back to the days when I went to graduate school. Well, we all studied at CAPM, and that's the way we thought about premium. Over time, I think that people have got comfortable with the idea that there are more risk transfer opportunities. If that's the case, hopefully the new equilibrium will be an equilibrium where those risk transfer opportunities and therefore risk premium belong into the long-term strategic portfolio, where the fees that you pay are not 2 and 20, are lower because the manager is helping you manage risk more than.
So this is great in theory. What about implementation, though? Right? Are we going to see more pivot funds? Are we going to see sort of low liquidity 40 Act funds? How is this going to happen with the required leverage, with the required long-short characteristic, the carry trades? I mean, how do you get it into a structure in which is actually maybe increasingly bound up? Is it going to be through smart beta ETFs? What's the structure? My mother-in-law is going to be trading futures contracts.
There are several structures for it. As you mentioned, for instance, there are the simplest one is just a commingled vehicle where you just have multiple factors combining there, and the manager offers the risk management, the combination, the T-cost aware transactions, and so on, which is. But
in a retail space, you're saying there's going to be a greater tracking here. It's going to be somehow the new definition of active share, but it's going to be factor active share. Is that what it is? Yeah. Why? What's your? Sorry.
No. And then I was saying, depending actually in different regions, like for instance in Europe, there is a lot of demand for what I was calling macro investing, macro factor investing, but you need to be on what they call a UCITS platform. So there are restrictions on the way you implement it because for some bizarre reason, the regulator decided that commodity futures are really, really dangerous. So, you have to adjust things.
All right. How are you seeing implementation?
So on the question of systemic risk, I think it's a very fair concern, but I would think from the other side of the question is if we have accepted systemic risk of the CAPM type of factors like asset classes, equity crash, bond blows up, etc., what's different about alternative factors? That we cannot accept the systemic risk, for one. And as long as the systemic risk of these alternative factors or anomalies are not synchronized with the traditional asset 60/40, I think there is still an important role for them to play, because that's where we want the diversification, right? But that brings up the peer risk of my clients again. If the 60/40 doesn't have a drawdown and you do, you have to explain, right? And the more high-level, my understanding on crowding as well is, my understanding is you cannot crowd away a true risk premium. You can choose not to take it. You can choose to stay out of it, but you cannot get rid of it from the capital market. So back to that risk transfer question again. So I personally anticipate if more and more of us endorse and start practicing factor investing, we may crowd the premium down just because we are willing to pay a higher price with the same risk aversion. We may crowd the volatility of individual factor higher because the long and short legs become less diversified. And maybe a bit worse is if more of us practice multi-factor investing, we may crowd their correlations up as well. So net-net, we will crowd their Sharpe ratio down. Sharpe ratio of individual factor, Sharpe ratio of multi-factor portfolio down as more and more of us get into that space. But I personally don't anticipate them to go to zero.
There are, in our industries, there are asset owners, and then there's a consultant group, and then there are asset managers. So given that there are products now in ETF on specific factors, and we've been talking about allocation to these factors, and we can, from a quant perspective, we can build that, and we can reduce risk in all of sorts. So that decision from asset managers seems to be, we want that decision, so hence we can charge it. Now, the consultants have also said, we can do that too. And so currently, when you guys are talking to your clients, and at the current environment, is that allocation decision across multiple factors being done at the consultant's layer, or is that being done in-house at the asset management layer?
And who's bearing the risk?
Yeah, well, it depends on the channel in a lot of ways. I think you're exactly right. For the most part, with a retail investor, direct to retail at Vanguard, that is something that's either the client is driving on their own, which you either think they're smart or you think they need a little help, or they're working probably through some sort of relatively straightforward, scalable advice model that will put that together that's probably affiliated with the asset manager. In Vanguard's case, that's either our advice service that's out there, the sort of robo-type advice, or some type of a fund that puts together a holistic portfolio for them, a target date fund or a balanced fund of that kind. If you're shifting now over to the institutional space, that's where you do have consultants that are in the mix, and they're making that call, and sort of their decisions will drive the choices that asset managers make about what product they'll make available, what they'll emphasize in the marketplace. But both things are happening.
When I ask my MBAs where they've been setting their 401k money, number one, it's indexing and it's target date funds. And I was wondering, in the context of target date funds, I guess there's two questions, one of which is more general than factors specifically, which is, do you think this is becoming maybe a somewhat crowded trade where the mechanical tilting from stocks to bonds is going to have an asset pricing implication? And the other is, do you see specifically sort of factors playing a role in target date funds, in sort of the planning for how do you invest at different stages of the life cycle of investing?
So glide paths, for example, across factor risks. You see it already in the hedge fund space. Different hedge fund risks are being brought into glide paths that are customized for DC plans at different times. What's the view? Have you heard demand for it? Have you responded to those ideas?
Well, I'll take a quick step on this. I personally wish to see in the future if some managers, asset managers, would be able to tell their clients, you know what, you are the wrong investor in this factor. For now, we are putting them together to say, well, this is a good portfolio of factors, but we got to understand that the first paper is one step forward in understanding that risk transfer, right? Macroeconomic risk and the like. There must be some others on this other side of the trade. And I have seen a few years ago one research work on understanding these long-term implication or short-term implication. And the results show, I mean, there's one piece of research shows that like they run these Bayesian VAR, and the value premium, if you look at the impulse response function, 20 years later, you still see that residual impact of a growth shock and inflation shock to value premium. Momentum premium, 2 years is done. Like low vol, different sectors, they all have different response functions to it. Like, will that be helpful for us to understand, well, you know, think about your horizon if you know maybe you are the wrong investor in some of these premium. But specifically applied to target date fund, I don't know enough to give intelligent answer on that.
I mean, the only thing I'll say is, at least in terms of how we think about it, the target date fund idea is broad-based, really a sort of single factor type view of the world, where you start with indexing and take the point of view that, look, that's a strategy that can work for everyone. Everyone can hold the market portfolio. We can control the amount of risk via asset allocation or another play. And then the question comes, for any of these other things, and so I'd ask you too, in terms of your students, when they're using indexing, are we talking about total stock market, total world indexing, or are we talking about REITs and other things that are sort of much narrower parts of the market? They're just implemented with an index fund, and they're in fact making active bets or active decisions around how to allocate risk. And I think that's the big challenge for target date funds, is exactly what Wai said, is what's good for everybody. And not everybody can be a value investor. We know that. So there's a bit of a challenge
right.
there.
Let's say this, just pass the mic on, which is that I think a lot of them are just handing off the entire business of how the portfolio is being managed to a target date fund. And somehow within the target date fund is a black box that's going to handle the issues of what's the right portfolio for me at different times.
Yeah, factor-based portfolios is the key.
And one thing just to add to that, we do see the behavior that I sort of alluded to for the most part there's this assumption out there that when people use a target date fund, they put all their money in one target date fund. And that almost nobody does that. And then when you look at it from a household perspective, that's certainly not the case with the household's assets. It's not in one portfolio. So the vast majority of people are using that sort of structure as maybe a core of something else that they've either put together intentionally or unintentionally that gives it a slightly different exposure.
I just wanted to give a little bit of pushback to Dick's question earlier. I think that Vanguard to make a pharmaceutical analogy, is a great generic drug producer. And at certain points in time, it's important that drugs that were invented before start to be offered by generic drug producers that can push the price down. But that doesn't mean that there is a lot of market and a lot of need for new drugs that are being invented, even if there are improvements on the earlier strategies that we had before. And particularly, I think the factor-based thing in the mutual fund performance attribution literature has been very, very harsh on the active mutual fund management market. Because we discover factors over time, and now when in 2017 we write a paper where we evaluate mutual funds, we put in the latest 5-factor model and go back to 1963 and evaluate that mutual fund manager against that new factor that was just discovered. That seems being very overly harsh. If somebody knew how to trade momentum effectively in 1975, that seems like a very skilled manager to me, if you'd ask me. So if we then take that seriously and say, well, why don't we take the Vanguard funds, the index funds, as the true counterfactual to investors, you will actually find that the whole underperformance literature of active management, that result goes away. On average, since 1977, the average active mutual fund has not underperformed the available Vanguard index funds. Now, some of that may be more driven by the earlier sample than the later sample, so there's still a lot of room for discussion there. But I think that it's important to realize that just saying, with Vanguard we have enough, I'm very much supportive of people driving down the price of investment management, don't get me wrong. But there needs to be room for innovation too. New inefficiencies will arise in financial markets, and new strategies will have to be invented to get rid of those inefficiencies.
I mean, is there any disagreement on the panel at all?
No,
I mean,
but I would say that's a very good point. But I would go back to what one of my colleagues said earlier. For the vast majority of institutions, talking about factor investing is a way of understanding what they really have in their portfolio. We are decades away, in my opinion, from saying, oh, should we evaluate managers relative to a 5-factor model? Most of them don't even know what factors they have in their portfolios. And so factor investing, that's one of the things that we actually said in our JFA paper, should be a way of, first of all, asking yourself, you think you have a 60-40 or a 70-30 portfolio. What is really in there? What kind of factors are you exposed to? And after that comes the question, okay, given that now you understand from a risk perspective what you have already in your portfolio, what should you like to add to it in terms of, improving the distribution of expected returns and so on and so forth.
So that's true even for passive vanilla beta products. You still want to understand what the underlying factors are, because to Dick's point earlier, you buy an investment, you
Most
buy
people
factor
put together
exposures
collections of vanilla
that are
beta
random.
products, and they don't end up with anything that looks like vanilla beta.
So the new buzzwords these days are big data and machine learning, AI. How does that fit into factor investing? Will that become a part of factor investing, or is that alpha at the moment and maybe going to convert to factor investing or beta down the road?
So it's a good question to end on, in the sense that it wraps it all up. Data mining, new innovation, is it structured, is it unstructured? How does it work?
I'll say one sentence, but it makes me worry a lot less about crowding, to be honest. I mean, there's a lot of stuff that goes on quantitatively. Some of it I think will maybe insightful and lead to outperformance and new sources of alpha. A lot of it may turn out to be quantitative, but not so smart. But it does lead me to believe that, look, you can have a world where we're low cost, very systematic, and still have a really wide divergence in points of view on securities and on asset prices.
As John said, one could be tempted to say, well, the good thing about big data is that maybe at some point it will create some differentiation across managers. That's the optimistic view. My concern is that, as for instance, as director of research of a quant asset management firm, I probably get about 5 calls every day from companies that go like, oh, we have a new data set, it's a unique data set, and it's so unique that I guess they want to sell it to somebody who has an Italian accent and nobody else, right? So it's a bit of a commodity. It's difficult to be super excited and say, yeah, there is going to be so much new stuff in there. It's costly. It takes a lot of statistical knowledge. In my opinion, you have to be really careful. More data, one could say more information is preferable, but guess what? It's another great opportunity for overfitting if you're not careful about it. So we'll see where it goes, but you're absolutely right. That's the thing. I mean, there are constantly dinners for quants where you get invited and people are talking about big data, alternative data, and I think they are actually the companies that sell big data running out of names because there are so many of them.
Okay, we're going to have to end the panel. Please join me in thanking our panelists today.